Hi, welcome to the BGL Healthcare Real Estate Webinar Series. I'm Dr. Mike Fabrizio. I'm here with my colleague Whit Holder, Michael Janis, and Sean Maynard. We're here today to discuss medical real estate and the value of owning your own medical real estate and potentially selling your own medical real estate in today's environment as a independent practice group. And I'm very honored to have Whit Holder, and my name is Mike Fabrizio. Once again, I'm formerly with Urology of Virginia. We were a large LUGPA group. We had 2 buildings which we developed and subsequently sold. Those buildings were multi-use buildings with an ambulatory surgery center and an imaging center and a large office space. And we're here today with Whit Holder, who is the CEO of Amarillo's urology practice. And Whit, would you like to introduce yourself?
Yeah, thank you, Dr. Fabrizio. Yes, my name is Whit Holder, and I'm the CEO of Amarillo Urology Associates, also CEO of AUA Surgical Center. And I appreciate both Sean and Michael having Dr. Fabrizio and myself here. Amarillo Urology Associates has been a independent urology practice since 1994, and we found ourselves in an interesting situation in 2019 with our real estate, and we went to BGL and did a transaction to do a sale-leaseback with them in 2019 of our clinic, and then had such a great experience. We did the same thing a few years later with our surgical center. And so excited to get through the details of that later on in this podcast.
Yes, and we had a similar situation. We bought our building in 2011, 2012, developed it, and then actually subdivided our land and created a second building of equal size, so a total of 90,000 square feet. And subsequently wound up selling the buildings for multiple reasons, and we can get into that during this podcast, which I think is important. One of which is that the valuation became so significant that it became difficult for us to create a equitable solution for buy-ins and buyouts. And so that was a good problem and a bad problem. But nonetheless, we were able to use the same acquirer of real estate, Montecito. We did not use BGL at the time. We used another broker, but certainly Montecito was the common theme in those transactions.
Great. And thank you both for that introduction. My name is Sean Maynard. I'm with Brown Gibbons Lang. So we are one of the leading advisors and brokers in the healthcare real estate space. We work with folks like Dr. Fabrizio and Whit's practice on a daily basis, helping educate them on matters related to their medically affiliated real estate and how that would look in terms of a sale transaction, be that a full sale, a partial sale, many of these different topics of which we will hit throughout this 4-part series. So talking through what we're generally discussing here, which is a sale-leaseback transaction. Now, this is a scenario where you would have a medical practice that owns its real estate and also occupies the real estate as part of its practice. In this instance, a sale-leaseback transaction is where the seller or the medical practice would sell the building to a third party who would now come in as landlord, and they would then lease that property back from the landlord under what is typically a long-term triple net lease. Effectively, what this does is it exchanges long-term stream of rental payments for a lump sum in that sale process. And I'll defer to my colleague, Mike Janis, to continue on with that explanation a bit.
Mike Janis here, also of Brown Gibbons Lang. And to touch on what Sean led into a bit, some of the implications of a sale-leaseback transaction, as he mentioned, it's exchanging future rent payments for a lump sum payment today. A key consideration with that is, analyzing a bit, what is my lease rate over the next, call it 5-10 years, versus how much money am I getting now? So the way to think about that is, reinvesting a lump sum at an assumed rate, let's call it 7%, versus your future rent payments received as a landlord. Another key consideration in the analysis of a potential sale-leaseback transaction is, the ability to really define your own lease terms and your rent terms, and pulling the lever between future rent liability and sale proceeds today. So you can decide, do you want a lower future rent liability, lower future rent payment to a landlord, which will result in a lower sale proceed amount on a transaction, versus paying a higher rental amount going forward, but also maximizing your sale proceeds for the practice.
I think that's an interesting explanation, and I think very good. The way I look at this is, as a practice, you're leasing space, no matter whether you own it or you're leasing it to somebody else. And if you own it, you're getting, as you said, Michael, a relatively small compared to the lump sum payment that you would get for a sale, semi-annual or annual dividend, as the investor slash owner of the real estate piece. And there is a way to monetize that, so you receive a larger sum up front. You're still going to be paying rent either way, but it's a matter of whether you're individually monetizing what you want to do. The analogy is, to use pretty current vernacular, is private equity transactions, monetizing a practice by selling it and getting a chunk of money up front, or even as simple as winning the lottery. Most people who win the lottery don't take their 20 or 25-year annualized payments. They usually take the lump sum up front, which is less than if they took the annual payments. And the reason for that is the time value of money. And so there's really no difference in really any transaction, whether it be real estate or a practice or a business or a lottery sale, and the time value of money. But in this particular case, if you have multiple physicians who are coming and going, that becomes a real issue with respect to the buy-sell arrangements within each of those practices. So that is a serious consideration. And especially given the value of medical real estate, which has really withstood the test of time with respect to valuations, cap rates, et cetera. It's probably the most consistent piece of real estate out there on the market.
Thank you, Dr. Fabrizio. And one interesting, thing to add to that is, we think about that decision analysis between a long-term stream of rental payments versus a one-time lump sum. Typically, rental payments that you receive as a landlord are subject to short-term capital gains, which are taxed at the equivalent of your ordinary income. Now, when you execute on a sale-leaseback transaction, the proceeds are taxed at long-term capital gains rates, which oftentimes can be 15 to 20% lower, depending on the state in which you live, 15 to 20% lower than your ordinary income. So there's also some pretty significant tax advantages, especially if your sale-leaseback transaction is priced at 15 times your annual cash flow. Taking into account that tax benefit, that could be more like 20 to 25 years of that annual cash flow on a post-tax basis.
I think for us, when we were looking at this opportunity for sale-leaseback, a few things that was really interesting is, for years we'd gotten our real estate valued, right? Because you had partners come and go, and so you get a value of your real estate. And over time, your real estate, you've pretty much paid it off and you've depreciated it out. And then you look at a sale-leaseback transaction, and you're not looking at a valuation anymore. You're looking at a cash flow valuation, which is a much higher valuation of that real estate all of a sudden, because you're looking at your rent payments over a continuum of time, and it really puts a value on that real estate much higher than what you've ever seen or experienced before. And I think when you're looking at a scenario where, as Dr. Fabrizio had mentioned earlier, where all of a sudden a buy-in to get into a practice is so large, mainly because of the cost of real estate, it's a great time to look at a sale-leaseback, to take that piece off the table so the buy-ins get lower, and also your current partners get an equity event that actually helps them in a time where it's harder to stay independent. And so for us, it had a lot of really positive aspects that we are happy that BGL came to us and basically taught us how this worked.
That's a great point, Whit. And I think we talk about sale-leasebacks, and I think people may have a little confusion about what the leaseback piece means. And That leaseback means that you structure a new lease upon sale of your building for a particular term, 10 or 15 years, which you've done anyways, and you have escalators, which you already have done as well, and you're usually comparable. But in our particular case, we were able to craft a really interesting sale-leaseback. The leaseback really allowed us to reduce the cost of our rent overall over 10 years for our practice. So one of the problems with the sale of our buildings is it created some controversy for the younger partners who had yet to invest in the building. And we had to explain that if you're going to invest, it would be a significant amount of money. And in all likelihood, based on the fact that we're paying people out who are leaving, and we have to finance that, we would not be able to pay much of a dividend. So are you willing to buy, just for example, $1 million house and have nothing in return for it, or $1 million investment? And so that was certainly concerning. But even that, they didn't understand. They're like, well, you're selling the buildings because you have to. We understand that, but you're also going to add cost to the practice. But in our particular case, we had two buildings connected, by the way, on the same campus. What we were able to do with the brand new building that we just built, 45,000 square feet, is we were able to create a lease that was slightly more than the current lease, but we were able to reduce the cost of the lease in the original building such that over 10 years, our practice saved $500,000 in aggregate rent. And so we actually reduced the cost of the rent by signing a new lease back to the new owner, in which case was Montecito, and we were able to effectively reduce the rent to the practice. And that was, I think, very beneficial. So you don't have to necessarily create a more expensive lease to do this. And that's the really take-home message.
Thank you for that. That's a great comment. One thing I would add related to the breakdown of values, you think about real estate, right? There's really two different ways to think about this. There's the bricks and mortar of the building, and this is going to be more akin to what you would see in your tax assessment from the county, right? But then you look at what is the capitalized value of the real estate, and that really is due to that long-term stream of payments. And so when you think about this, it's really, you're selling, it's an off-balance sheet financing transaction. It's the practice selling a bond, right? Because as you incur the liability for that long-term lease, that's not put onto your balance sheet. That's not assumed as debt. So if you have debt on the practice otherwise, just for, whatever other capital improvements, equipment needs that you might have had, any covenants that you have related to that, right? Typically the bank wants to make sure that you have positive cash flow, that you're not incurring too much other debt. The long-term liability related to a sale-leaseback does not impact your balance sheet if structured properly. And so therefore, this really provides an opportunity for the practice, the cash flow from the practice, to provide liquidity to the partners through the actual physical real estate without having an on-paper impact.
Great. Now let's get a bit into how this valuation, drops down from the operations of the physical real estate and the leases therein down through so the valuation and the cap rate. But starting at a high level, what is really looked at is the net operating income of a facility. That's the NOI. So what is the NOI? The NOI is your revenues for the facility minus your expenses for the facility. So the revenues really encompasses the rental rate that is going to the landlord, as well as expense reimbursement income. And then you drop to the property operating expenses. These are typical expenses for running a property. This is your repair and maintenance, your utilities, your real estate taxes, and your insurance. So the difference between the revenue and the expenses is your net operating income of the facility. Important to this, particularly in a single tenant medical office building or surgery center, is the lease structure. And the most desirable type of lease structure would be a triple net, wherein if there's one tenant in the facility, they will pay their pro rata share of those property operating expenses. The pro rata share for a single tenant building would be 100%. So they are reimbursing the landlord for 100% of the property operating expenses. So you're really looking at, in that top line revenue, you're looking at the rental payments to the landlord plus your reimbursement for those expenses. And then you are subtracting from that revenue the actual operating expenses. So they're really zeroing each other out. The resulting NOI of that property will then be the rental rate for the property. So you really get to that NOI number, which is the key profitability metric for these facilities, and how an investor is looking at their ability to invest and how much how much proceeds they will be submitting to the seller. So moving into the cap rate, then the cap rate is it's really how real estate is valued from the investors, and what you're doing is you are dividing the net operating income, the NOI, by percent. It's really the first year's return on the investment. So you're taking that first year's NOI and you are dividing by a capitalization rate, and that is how you're getting to the value of the property. And the cap rates are really a good comparison for the strength of the market and the aggressiveness that investors are willing to pay. Really, falling cap rates are indicative of more demand and more aggressively priced assets. And rising cap rates suggest declining value and increased risk in the market.
Great. And to build on that, as we think through some of the as how real estate is valued and how that cap rate is calculated, there's really a couple key terms. Obviously, the NOI, right? That cash flow, that's going to determine the ultimate value of the property as you compare that to a cap rate. But other key terms here, right? You think about the lease term, right? So the amount of years that initial lease is in place. So that's going to be critical to investors. If you go back to the analogy of buying a bond, if you were buying a bond that's going to give you steady cash flow every year for the next 10 years or every year for the next 20 years, you're going to end up paying more for the bond that's going to give you cash flow for 20 years. Now, separately, one of the other key items that Dr. Fabrizio had hit on is the annual escalators. So what is the amount that your rent is increasing on an annual basis? This is very important to investors, as this touches on how does that cash flow annually keep up with inflation, right? Because as we all know, $1 today is worth more than $1 tomorrow. So any investor is going to make sure that the rent dollars they're receiving next year are worth just as much as the rent dollars that they're receiving today. And separately, to triangulate all of this, investors will look at what is the price per square foot of the property. Anybody who's gone and built a property before understands that at the end of the day, you're going to get a quote that's going to give you the total cost to build the property. How many square feet is that property? So there's $1 per square foot to build a similar property. That's going to be a governor on the high end of the valuation that you're able to get based on that income approach, or taking your NOI divided by a cap rate. If that amount is over and above the replacement cost, or what it would cost to build a comparable property, there's a good chance that investors might have a bit of heartburn. And so that's how we think about the decision to buy or to build.